Live, the technical analysis edition this week here. It is Tuesday, November 19th here. Jace, how are you today?
Hey, Roger, I'm good. Looking forward to another show. A few charts to have a look at, plenty of viewer stocks to have a look at as well, I hope. It should be fun.
Yes, as always. Sorry we're a couple of minutes late, as there could be a bit of it was a bit of a technical challenge getting online today, but lights are still on. And as you can see, the technical challenge was that my name on this video says Jason McIntosh from Motion Trader. I'm Roger from Selfwealth, so come and say hello to me anytime, whether it be via LinkedIn or sending an email to support at Selfwealth. I'm here to bring your questions to light here on the show. All right, so ignore that because Jason is a much better looking person than what I am. And that said,
don't sell yourself short, Rog.
That said, I want to welcome everyone to the show. The funny thing is, I'm hoping that there is some people behind the screen because I haven't seen any chats come in yet. So I might just say hello, everyone, and see if anyone's coming today. See if anyone's here. Can you hear and see us? If not, Jace, let's please get going. Well, I can see there's 11 people looking at us, right? So let's start with our disclaimer, if that's okay.
Right. Okay. So everything we do today, general commentary only, no personal advice. And I'll quickly put up the disclaimer that we do each week, and that just goes through that. I'm also not part of Selfwealth. My business is, of course, Motion Trader. You'll see my details at the top, licensing, etc., and Selfwealth is beneath that. So yeah, all general commentary only.
Fantastic. All right. Well, thanks, Jace. Look, it's been another sort of sideways week this week. I know for me, it's not too exciting. Although we are starting to come up a little bit again in the Aussie market. Let's get straight into it. Obviously, as you know, we're going to analyze as the viewers know, if you're the first time, we're going to analyze the Aussie market, the Hong Kong market, and the US markets. Then if there's any general questions, we'll get into that. And then we will start analyzing your tickers as well. But let's start with that Aussie market. Jace, how's that looking right now?
Okay, well, let's jump across to our charts. And the first chart we have today, as always, is the ASX 200, and it's been a constructive week. From when we spoke last Tuesday through to today, I think we'd call that a constructive price action. Since last week's show, prices have rebounded off the 50-day moving average. So, as I typically have on these charts, I'll have the 50-day moving average and the 100-day moving average. And they're both, I find they're both good moving averages to use from a medium-term perspective. Nothing wrong with using other timeframes, but I like to look for trends that could run for maybe a year or two or maybe three, and I like the 150-day moving averages for that. And we're seeing this nice rally off the 50-day at the moment. I think the question to consider is whether the market is ready for new highs or whether there's some more consolidation to come. To help answer that, let's have a look at two of the dominant sectors in the local market, and those being the financials and the materials. So let's start with the financials. I'll just click over to a financial index. So this is actually an ETF. It's an ETF for the ASX 200 financials. And what we have here, it's like, well, this is the financials have really been leading the way at another all-time high today, and it's a trend which has been a strong trend which has been in place for really the last 12 months. You can see where prices broke higher in December last year, and it's been a nice steady rally with pullbacks, of course, and this is why we use those 1,500-day moving averages. They often provide a good supports during rallies, and that's been the case in the financials. Now, Rog, I think when people see a market up here at the all-time highs, the number one concern for many people is that they go, look, this run must be nearing an end. It's too late to buy now. It's had this great run. It's probably coming up to some sort of a peak. And yes, at some time, an all-time high will be the peak. But I think the way we should be looking at this is that the odds favour that all-time highs will lead to more all-time highs, because that's how trends work. Doesn't mean week after week or day after day or even month after month, but as a general proposition, a market which is travelling above rising moving averages and hitting all-time highs, it's doing that because people are buying it. There's money coming into the sector, and this has been a strong driver of the ASX 200. And I think we could say the financials really are underpinning the local market for most of this, pretty much all of this year. Now, the other side to that, the other big sector in the local market are the materials, or is the materials sector. And this contains the big miners. And when we look at this, it's really been in a big range for around 3 years. So just compressing that a bit, and you look at this. So there's 3 years of the materials. So BHP's the biggest stock in there. Then you have all the other mining stocks and other stocks related to the sector. And yeah, 3 years, this is just not done a great deal at all. I was watching this with an optimistic viewpoint just recently. You had this rally from below the moving averages to above, had this very corrective looking pullback to the moving averages. And I thought maybe the materials are getting ready for a move up towards the top of their trading range, but that hasn't happened. Last week, we've had this swift fall below the moving averages. And I think what that means now, it like the rally possibility I was looking for, that hasn't played out. I think this pullback, I think it's neither bullish nor bearish for the materials. It's just stuck within this big range. It's just going nowhere. And so when you think about what the materials are doing, how the materials are not contributing positively to the overall market, coming back to the ASX 200, the fact that the ASX 200 is being able to rally off this 50-day moving average and be approaching the all-time high, I think that's a positive thing that the market's done that. The game plan throughout this year has, since the market's been above these averages, the game plan this year, it's been stay long equities, of course, manage risk, but generally be focusing on owning stocks, and that hasn't changed. Hasn't changed where we are right now. I had been thinking that we might see some more consolidation. I was thinking maybe some more consolidation back to the moving averages before potentially a year-end rally. But if the upward momentum is going to start from now, well, then I'm happy to go with it. Go with the trend. Go on the side of momentum, not trying to pick tops. Just briefly, we'll just have a quick look at the equal weight, the ASX 200 equal weight, and this is also useful to look at because it takes out the emphasis on stocks like BHP and CBA, and it's looking at the ASX 200 with each stock ranked equally. And this is constructive price action, what we're seeing. So had this 10% rally in the market through September into October. Not surprising at all, given the extent of that rally, that we're getting a pullbacks, come back to that 50-day moving average, and now we're starting to get that rebound off it. I think it's encouraging the market has found support, or has been finding support around the 50-day moving average. It's something we often see in bullish trends, that we get these periodic pullbacks to the averages. Also notice how prices have come back to the breakout point. So we had this, I think this was a 5-month trading range that the equal weight was in, had a breakout, had an initial rally. And this is something we often see in markets as well. You get an initial rally out of a range, then you get some profit taking in, prices pull back, and then this is where you want to see the buy the dip as prices come back to the breakout point. So far, that's what we're seeing. Prices are starting to move higher again. So I'll continue to play this from the long side. When I say long, I guess that's a jargony way of saying that I own shares and I want to own shares, and I'll actively look to get more shares. So when we're long the market, we're approaching the market in a positive manner, wanting to be invested. And but should the market turn and come down, and the breakout fails, and prices are back below the top of the range, well, then that's what we've got risk management strategies for, to protect capital should that happen. But at the moment, that's not the play. I think the play now at this stage, it's focusing on this continuing momentum in the trend.
Yeah, well, it's once again, it's good to see that you've brought up both charts, the AS 200 and the equal weight one, because there's probably no surprise for a lot of people that the financial sector is bringing up a lot of the ASX 200, considering the interest rate environment at the moment. So good to be able to see that it's holding itself up, not just based on financials as well, right? And seeing that overall picture. Quick question, maybe I'm jumping the gun here, but I'm thinking leading into Christmas, traditionally, what do you see it just consolidate or come down at all? Or what? I mean, obviously you don't have a crystal ball, but what's happened in the past around Christmas time?
December's a seasonally strong month, and there's a long history of, and you'll hear in the media as we head into December, you'll hear of the Christmas rally or the Santa Claus rally, phrases like that. And that's because often we do see strength heading into the end of the year. Doesn't mean it has to happen. So seasonal factors they're like a barometer. They tell you, they give you a guide to something which could be coming, but they're certainly not like a GPS which is going to pinpoint something which is where something is or where to go exactly. It's so December's, as I say, seasonally strong. I think the way the markets are setting up, I think that's shaping up as the play as we move into December this year. Like when you've got a market which is rising above rising moving averages and you're going into a seasonally strong period, well, of course, the odds favour that continues to be the play to go with that trend, not to second guess it and say, oh, well, look, something different will happen this time. Something different could happen, but I think the odds favour to go with that seasonal strength, unless we have cause to think otherwise at the moment. I don't see that cause to shift overly defensively.
Okay, fantastic. All right, well, just having a look at the S&P 500 now, we can see it's sort of retraced a little bit perfectly into that consolidation point there. So
yeah, so this is where I think things get important for the S&P 500. So we had that initial post-election rally, so 50-day moving average, 100-day moving average. Like the ASX 200, the US market has had that rally off the 50-day moving average. That was the post-election surge in the market, and that's taken the S&P 500 up to a new all-time high. And now we're getting the pause and the pullback. So what's important about this is where we get to see how much interest there is in buying the dip. And I think this is important because if this rally we saw on the election result, if this was all just froth and hype, then prices could quickly retrace all of that gain and be trading back down below the 50-day moving average. So this is why I say it's important what happens here at the moment. But if there's money waiting on the sidelines to come in and there's going to be interest in buying, well, this is where I'd expect the pullback to start finding support, and for the S&P 500 to then be holding on to most of its gains. It's where the buy the dip would really start to come in. So I think this is where we get to see which it is. Was it hype and unsustainable near-term surge, or is it the real thing and the dip will be bought? I think we'll find out soonish. Similar story when you look at the other indices like the Dow, you look at the NASDAQ, the S&P 500 equal weight. They've all got this same basic structure to them. We can also what we can also do, we can also put on a Fibonacci indicator to give an idea of a potential pullback range. And these Fibonacci's are something which I occasionally put on there. They can be interesting. They can give proportion to a pullback. So let's just do that now. So we use the low from, so we had a high, had a low. So you use a low point from a previous pullback. You take it up to the high point, and then you get these this shaded area. This is called a Fibonacci retracement area, and often markets will come back to somewhere within this region. So this midpoint is a 50% retracement. It's a common retracement level that markets often come back to, and I think these can be useful just to help frame our expectations for a pullback. Simply having an idea of what could happen helps us mentally prepare. And I can show you how these have played out at other periods, like just looking at some of these previous rallies. So from the low to the high, there's our Fibonacci region, came back to about 50%. Then we can do this other rally that we had in September, October. From the low to the high, came back to the top of the Fib region. So you can see how they play out. I don't use them to trade off. I use them just for a guide to give an idea of proportions. One thing that could happen is now we've had this pullback into the region. There could be some more chop while the 50-day moving averages catch up. That's one possible scenario. But from a trend perspective, it's still a case of we've got these rising moving averages. We've got the rising 50 and 100-day moving averages. And whilst that remains the underlying condition, I think the play here is to stay long the market, give the prevailing trend, give it the benefit of the doubt. For me, it's not about trying to pick tops. It's about trying to stay on big trends for as long as possible. And I know if I try to stay in these big trends for as long as I can, I know that I will give back some profit at the end. Ultimately, these trends end, and you get that's the price of staying on a trend for as long as possible. You've got to give something back when they ultimately do end. But look, for me, it's a case of trying to maximise my time with the trend, because I think the big money's made by being optimistic about a big trend extending higher than being pessimistic that it's going to be close to an end. So, as I always say, stay with the trend, invest with the trend, be optimistic it can continue onwards. And then, as always, the key is just having that good risk management strategy. It's not being blindly bullish no matter what. It's having that good risk management strategy so you've got an exit plan in place. And that's what keeps you in the game long after a trend ends, knowing when to sell. But at the moment, it's a case of trends in place.
Yep. And obviously we did a fantastic show a few weeks ago on knowing sort of when to sell and having that plan. So just check out that one around stop losses there. I always think, whilst we do have stop losses in the system, it's always better to manage them and look at your positions day in, day out, and just make sure you obviously don't spend forever there, but just making sure that you're on top of your positions, because too many horror stories of people logging in after months and and realizing they've lost all their not realized losses completely yet, but they haven't sold, but they've realized that they just haven't managed their positions right. So Rod,
this is the thing. It's like individual shares carry significant risk. It's not I think it's a dangerous game to be a passive shareholder in individual stocks and not look at them, come back in 12 months time and see what's happened. It's now you can buy an ASX 200 ETF and not look at it for 5 years, and unless the world comes to an end, it's like it should be fine. It's and history tells us that over time that almost certainly will continue to go up. And the way an ETF works is it throws out the weaker stocks, it brings in new stocks as new stocks start to grow and emerge. So an ETF is, in a way, a longer-term trend-following approach, because it does stay with the stronger stocks. It's a bit different, but it's the similar concept. Individual stocks, very different thing. A stock can go to zero, and if you're not looking at your stocks, a stock which seems good now, in 12 months' time, it happens. It can be delisted. It's happened before. It's probably not going to happen. To odds favour in a 12-month period, your stock, if it's going well, it's probably not going to disappear from the ASX within 12 months, but it can happen. So if you've got individual stocks, I think you don't need to be staring at the screen every day, but at least weekly, have a look at your portfolio, think about, okay, where would my exit be now? What do I do? What do I do if the market turns down and the stock comes back? Where am I getting out? So you've got a plan. And it's not just, I'll worry about it later on, because when things get a bit crazy, that's when things also get a bit emotional, and it's harder to have a clear head when everything's getting volatile. So you make your plans when everything's cool and calm, and you execute it when things get a little bit more emotional. I think that's the way to play it.
Yeah, perfectly said. And as we say in this show, we sort of more around active investing, right? But as I read in a lot of forums, a lot of people don't realize what kind of trader they actually are, and I thought want to become or want to be. And I think that's probably the number one question you should always ask yourself, in my eyes. Now looking back, how much time do you want to spend in investing? If you don't want to spend any time, then just ETFs are the way to go, really. But if you do, I see so many people in forums want to invest in individual stocks but not have any game plan. Yes, it's definitely a recipe for an interesting time ahead, I think. So but all right. So don't forget to put your tickers in, guys, and we'll get on to them. There's a few there already, which we'll get onto. We'll get onto them ASAP after we've had a look at the Hong Kong market.
Okay, Hang Seng, sharp pullback during the week, and prices are now back within this 50 and 100-day moving average range. You could also say, look, this is your classic zigzag. From the high, it's come down, it's bounced, it's fallen again. So that's the classic zigzag corrective formation. I think this is a key moment where prices are now. If this rally from September, October is the real thing, then I'd really think this would need to see this pullback start to stabilize. If it starts coming back anymore, well, then it starts to resemble this failed rally from late 2022, early 23, where like recently, it was a strong rally, had the initial pullback, but then it never really found support and just continue to ebb its way lower. So that's not where we are at the moment. There's still time for this to find support. I can put some Fibonacci's on this too. Like, which low do we use? Let's say we use that low. There's a bit of discretion in these things where you measure your low and your high from. But at the moment we're within the region, so that's fine. But if we really start to fall below the 100-day moving average, start to fall out of the Fibonacci region, that's when you start saying, look, this rally, this is probably not the real thing. And then we're left should that happen, then we're left in a situation where we really start looking at this then of being a big range. So at the moment, I think we can look at this from the perspective of we're still giving. I think it's still worth looking at this, giving this the benefit of this is still has the potential of being a developing upward trend. But it needs to really start to hold the line at around current levels. Otherwise, then we start looking at the a big trading range where its trading range is pretty much walk away until you get a breakout. Chinese market's a little bit different. It's been stronger. It hasn't had that same pullback that we've seen the Hang Seng, at least not yet. There's nothing to say it's not about to have a similar sort of snap fall. It's continuing to find support along the 50-day moving average. That's encouraging, but I think this is still a developing situation. I don't think there's a hurry to do a lot, and it probably continues to need more time. Let's wait for this one to stabilize, and then I think to see it start breaking high, gaining momentum. That's probably the time for it to come back into play.
Okay, fantastic. All right, let's get on to some questions here. First of all, Graham has some good little insight around the end of the year, what could potentially happen, obviously. Odds favour upside to the end of the year, some selling by mutual funds to fund distributions, buying for these distributions. So that could be one of the reasons why we get some upside towards the end of the year, which is great in insight. Let's have a look at the question here from Macouse. Duratec was sold off when it hit its ATR stop loss level, but has since improved with the cross of the 50 and the 100-day moving average. What does the chart say to you?
Yeah, so Duratec is it was a motion trader stock. So we got it, and I had this in my own portfolio. So you can see, like, let's just go back. This is probably where the buy signal was back in August 2022. And this is how a lot of emerging trends start. Have a period of declining share prices. The shares start to find stability, go from below the averages to above, hit a new high. That creates some buying momentum, and we get a buy signal. Don't know which signals are going to do best, but you just follow this sort of process, and over time you can get some good trades from it. And this turned into one of those good trades. A developing uptrend turned into quite a substantial uptrend. Now I use a wide trailing stop to stay in trends for as long as possible. My wide trailing stop was able to see off this pullback during October last year, but then it's probably around, not sure exactly when, around March or April, somewhere in this vicinity, the pullback was deep enough to trigger the stop, close the position. And now what happened? Now the thing to keep in mind with a trailing stop, it's not like a magic point where the stock goes from it's going up to, okay, it's hit the trailing stops and now it's going to go down. It doesn't tell you what the stock's going to do next. It's just telling you that now's the point to protect capital, that you've given it enough time, you've given back enough capital in the pursuit of trying to stay with the trend, and now it's time to just rule off, protect the capital that's there, take it out and redeploy it elsewhere. Because we don't know. We don't know what's going to happen. When we're looking at this point here, let's just say that was a trailing stop. We're looking at here, we don't know. Is it going to find support and go back up, or is it going to unravel and keep declining? We don't know the answer to that, so the play is protect capital. Fell a little bit more, found support, started to go back up, back above the averages. Averages have crossed again, hits a new high, creates a new signal. So this is another stock. So we've got the criteria for a trend back in place. Now, some people say, "Oh, well, I shouldn't have sold it. I should have ignored the stop and just held on." And what I always say to people, it's not the stocks that rebound and go on to new highs that cause you problems. It's the ones that continue falling and find their way all the way back down to where you got in and further. So we can't distinguish one from the other at the time. So I think we need to act on the basis that every stock has potential to go to zero if we don't manage our risk. And that's why we cut positions and not just hold on and hope for a rebound. We've got the rebound in Duratec now. So the structure's in place for this to be an ongoing trend. Whether it repeats what it did the last time we got an initial entry point, I don't know. We can't know. We can't know that, but we do know there is the makings of a trend. How far this trend goes, I can't say. I don't know. It could stall here and come back, and it could just be triggering a new signal before coming back in and spending more time within a larger range. So there's nothing to say that Duratec's not going to do something like this over the next 9 months and just be a big range bound stock where it triggers an entry point, gets you out again, maybe triggers another entry point, gets you out again. This is why we have many relatively small trades, because we don't know we can identify the setups with the potential, to do very well, where we can get an asymmetric risk reward profile. That's where we can, risk $1 to make $3, but we don't know which setups are going to play. So it's got the setup there, but it doesn't mean that it's going to play out this time around. So it'll be an interesting one to watch.
All right, fantastic. And Talwin also says recent earnings and fundamentals also good for this company. If you are interested in learning more about that, please go and do your own research around that company, Duratec.
And it's a great example, Roger. It's a great example of the sort of stock that you can find when you look outside the ASX 200 or the ASX 300. I think when it first appeared in the motion trader signals, I don't think it was even in the All Ordinary, so not in the top 500. But this is where emerging companies come from. They, like Talwin's saying, it's got this good financial profile. It's like this is how stocks make their way through the ranks, from the All Ords to the 300 to the 200 to the even into the 50 and beyond. They typically start as smaller companies and they get bigger. So this is where I think there's a high potential area of gains when you've got that ability to scan for stocks which are outside the big names. Duratec, like who would have heard of Duratec? Most people still haven't heard of it, and most people wouldn't know what it does. And it's a stock which has gone from say 30 cents to $1.80. So it's worth being able to look beyond the big names to these emerging companies.
Yeah, I think you're absolutely on the money, Jace. I mean, I still don't know what it does, and I'm pretty sure it's still part of my portfolio as well. So I might look into it. Someday. What I was going to say is the next one we want to look at, actually, because I skipped it. Sorry, Jacques. But let's have a look at IBM, please. Not IBM, IMB. Sorry, IMB.
Yeah, well, it's had we looked at a few weeks ago, I would have said, look, trends in place above the rising moving averages. If I had it, I'd be happy holding it. And this is a thing, we don't know what comes next. All we can do, we can see trend, we can work on the basis that the odds favour the trend to extend, but at some time a trend will peak. And this one's peaked quickly and had a rapid about face. Not all trends end so spectacularly, but this one has. This was a motion trader stock. It may still be. I'm not sure whether I can't remember whether I've seen in the exits, but it is quite a steep pullback. I would have thought the trailing stop probably would have triggered on this one already. If not, it had to be very, very nearby. But I've got a feeling this one's already exited the motion trader portfolio. For me, this is definitely a void. This is not a dip to buy. I'm interested in buying the dip when a stock comes back towards these rising moving averages. As we can see, stocks periodically do. I'm not interested in buying when they're below moving averages. As we can see in this period from April, below the moving averages turned out to be a low and it rallied, but also it can be a point of vulnerability where it initially pauses then declines. So I don't buy dips below moving averages like we currently have now. I think given the extent of the fall from above the moving averages to below, I think there's a reasonable chance we get some sort of a rebound back towards the averages. But this is a stock in a vulnerable position. I wouldn't want to be buying it based on the possibility of a rebound back to the averages. But if I had it in my portfolio, I might be using a rebound back to the averages as an opportunity to get out if I'd missed my trailing stop for some reason. Sometimes I'll use the rebound back to the averages as an exit point, and we can use these recent lows as a secondary get out point should the rally falter. But yeah, it's this one's not playing out now. It's I think it's time to move on from it.
All right, let's have a look at BMV.
Sorry, what was that, Rog?
BMV. Oh, sorry, I'm maybe PMV.
Not dissimilar to the last stock in that we did have a trend which was progressing nicely enough. Now we've got a fall which is taking us below the averages. The averages have rolled over. The averages have crossed. Price is consolidating below the averages. So for me, this stock's now in a vulnerable position. Just looking at some more history on it, it's a situation where, again, where I don't want to buy this one. It doesn't mean that it is going to unravel and continue down. It could, like, there's support. Like, you just look at these previous lows. So there is support around where it currently is. Maybe it does support here, and maybe it does find support here and rebound, and it's just going to spend time traveling sideways. Like, we could get a situation where this stock, it just travels sideways in a range for a period of time, and then breaks higher. There's all sorts of pathways a stock can take, but I don't think the odds favour buying a stock when it's in this position because it is below those moving averages. So I always worry that a situation continues to deteriorate. So that's why I don't want to buy it. And if I had it, I'd be probably looking. I'd know where my trailing stop is, and I'd be looking to exit if it hits a trailing stop, and move the capital elsewhere. At the moment, it's lost its momentum. Maybe it comes back in the months ahead, but at the moment, it's lost its momentum, and it's not a stock I'd be actively looking to acquire.
All right, thanks for that. All right, Jennifer says RDX is looking good. Another motion trader signal. Can you have a look at the chart, please?
Yeah, well, isn't this going well? But look, like we saw with IMB or IBM, the one we looked at earlier, your stock can be going well, and then it can take a tumble. So we never want to get overconfident. We never want to get complacent because conditions can change. At this point, I'd be happy holding this stock. I'd be letting it run. I'd be using my wide trailing stop, which would be below the 100-day moving average, and just see where this one goes. I'm probably not a buyer at the moment, given it is getting a bit stretched above the 50-day moving average. I'd probably rather wait for the next consolidation and then see if that provides an opportunity. But yeah, I'm more than happy letting a stock like this run.
All right, fantastic. Good one to hold. Let's have a look at daisies. Let's have a look at ATA, please.
Yeah, so I've got this one in my own portfolio, and it is. So I've got the initial signal for this, where you can see whether it's gone from below the average to above, had a pullback to the averages, then rallied again. That's been the initial signal. I'm not sure where I got in. I've got in a little bit later, I think. Probably I'm probably in around break-even levels. It's had that initial good run. Now it's come back to the averages. So at this point, I'd be giving this the benefit of the doubt and saying, okay, it's had that initial strong period, and now it's consolidating that. If I'm a buy the dip person and I really like this stock for some reason, it's like, well, this is a potential buy point, because then you say, look, if I bought it here, I could have a stop below the 100-day moving average. That's about 10% of risk. 10% of risk in a stock which can be a bit volatile is probably quite a reasonable entry point from a risk perspective, and it does have the potential, if it can stabilize here, that it then breaks higher again and continues upwards. So whether it plays out like that, time will tell. But it's all comes down to, all we're doing each and every trade, we're looking at our risk and we're looking at our potential upside. At this point, the setup is in place where we've got a stock above moving averages. It's pulled back to the averages where it's still got significant upside potential versus the risk we need to take to maintain a position in it. So I think it's, for me, as I'm doing myself, it's one to hold.
Okay. All right. RWC.
Yeah, little bit messy at this one. So we've got this underlying trend, but you can see it's really chopping its way higher. Like just going back to 2023, how it's rallied, then it's come back below the moving averages, looked vulnerable, then it's turned up again, then it's fallen back below the moving averages, looks vulnerable, then it rallies again, and we're doing something similar now. It doesn't have the consistency to the trend that we see in some stocks. It does have a general underlying upward trend to it. It's not a stock I'm particularly excited about just because of the messiness of the trend. But if it's in a portfolio, I don't see a problem with continuing to hold it, provided there's, as always for me, I'd want to have risk management around it. I want to know where my exit point was in the situation that stalls and starts to come back down below the moving averages. Just because it's stabilized and these other times it's been below the moving averages doesn't mean that will always happen. At some point, it could be below the averages and continue lower. So I need to know where my exit point is. But yeah, it's not a stock I'm overly enthusiastic with, just because of as I say, about the inconsistency in the trend.
Okay. All right. A great question here from Terry around stop losses. Do you put in a sale order based on the calculated stop loss ahead of time? I put alerts, but sometimes it gaps down and you can lose 30%, e.g. PDN. Maybe we can bring up PDN. What's your view, Jason?
I don't have live stops. Actually, it depends what I'm trading. My background is I worked on an investment bank trading desk. We traded futures and large foreign exchange volumes. And when you're dealing with leverage and large volumes, you use a stop loss, which is always live in the market because leverage can spiral quickly out of control. So in that setting, I always use a stop loss. When I'm trading individual stocks and I've got many relatively small trades, so I might have 50, 60 or 80 trades in play, and they all the initial investment in each stock might be like 1.5% of capital or something like that. So the money at risk is relatively small. So for that, and the fact that there's so many stocks, it'd be a time-consuming process to each day be updating the stop losses on it. Given the risk at stake in any single stock is small compared to the overall portfolio size, I'll look at my exits on an end-of-day basis and go, okay, this stock and that stock hit. And this happened to me last night. I had two stocks, they hit their exits during the day yesterday, and I just put orders in this morning to sell them. I'm out of one early this morning, and then one the order's still working. So I'm relaxed about it. It's not a big deal because they're relatively small positions within a larger portfolio. So having, like Paladin was the example, PDN, and a live stock wouldn't have saved us from this one here, this gap. So you can have a stop loss, and if the market gaps, you still don't get filled at your level. Of course, you get filled at the first tradable price. So in this case, it's like it's not a difference of getting out at your level or losing 30%. You're going to lose money regardless because you're going to get, we call it slippage. It's slippage when a price gaps beyond a stop loss. That's the extra amount you lose. And again, this is the advantage of many relatively small trades. You can get a loss in a stock like Paladin, and it's not the end of the world because if you've got a 3-stock portfolio, well, it's going to be pretty ugly. But if it's one of 20 or one of 30 or 40 stocks, it's always frustrating to get a gap lower, 30% gap lower. But when you tally up the numbers, you're going to come back tomorrow and play again. It doesn't take you out, and it's not a great emotional hit either when you actually look at the the percentages involved to the overall portfolio. So it's an individual thing. Live stop or using alerts. It depends what works best for the individual. What I do is not going to be best for someone else. Someone else will want the surety of having a live stop loss. Some people also tell me that the live stop loss enforces discipline because their stocks hit the exits and the broker just sells them out. They don't have to think twice about it, because sometimes I'll say, oh, well, look, I'll give it a little bit longer and the situation deteriorates. So it depends on you. It depends what works best for you. That's how I'd approach the live or not live trailing stop, but just making sure that you have an exit strategy. I think that's the overriding key to the whole thing, just having that plan of when to sell.
Yeah, I think obviously it's always going to depend on your plan and how you deal with it, right? But having those ideas of what you've given us is a good thing as well, right? And how you may handle it. I just want to sort of reiterate on the point as well, though. Like if it also depends on the order type that you put in with a live stop loss, right? So if you put in a market order, market then limit order, you put in, it triggers, right? And then you put in a market then limit order, your order would maybe subject to slippage, right? Because you'll be filled well below the price, and you don't even know what sort of price, the best price you're going to get down after it gaps down. But if you end up putting a limit order in, limiting the price that you're selling at, then it may gap below you get triggered in, but your order stays in the market, remains in the market until the price is back at that level, back at that level, basically trading at that level. So you might think that you've been stopped out or you've been sold out, but that's why it's really important, even with a live order, just to make sure that if you put a limit order, you may not have actually been filled because it's gapped down well below your limit order, right? So just understanding the different order types when you're sending in the Selfwealth system. I mean, I'm pretty sure most stop loss systems work across the platform, across the board that way. But understanding when you're putting a stop loss in, it's just a trigger price, so the price will get triggered. And then it also depends on the type of order type you put in. Whether it's a market then limit, then you'll be subject to slippage. But if it's a limit order, then you might not actually be filled at that point because it's gone past your price, right?
Yeah. So here's an example, Rog. So say we're in Paladin. Here we are. We're in Paladin at this point here, and we're looking at, say, the market's at 972. We've got to put a stop loss in the system at $9, and we've got a limit at 875. We think, okay, it's 25 cents. Surely we should get filled within that. But if it gaps lower, I'm not selling. And sure enough, the market gaps lower, triggers a stop, goes straight through the limit, so there's no trades. So this person is potentially still in the stock. And if they're at home, they only like to log in their account once every 6 months, and they go, oh, but that's okay because I had a stop loss, I'll be filled. Well, they're actually not. Because they had a limit in there, and a limit can be a good thing because sometimes you get markets that spike on low volume, so that's the reason you want a limit, because you don't want to keep feeding stock into an illiquid market, which just keeps tumbling because there's not many bids there, and you end up selling at a ridiculous price, and then the market snaps back. That's the whole reason for having a limit. But the flip side of that is you can also get a stock which does this, and you don't get filled. So always just got to keep an eye on things. There's no perfect way to do anything, but you just got to keep an eye on things. It's none of this set and forget. It's not an ASX 200 ETF. Individual shares are different creatures, and they've got to be managed. Or you can just get a nasty bite when the unexpected happens, like in Paladin.
All right, fantastic. Thanks, Terry, for bringing that up. I'm glad we brought that up. Let's have a look at the next one, which is Cat, please. Cat.
This has been a good one, and I've got this one myself. Nice strong uptrend. It's a great example of an uptrend in that you can see we've got the rallies, pulls back or trade sideways into the moving averages, rallies again, back to the averages, and you can just see this sequence continue the whole way up. For me, it's a case of just holding the position, letting it run, wide trailing stop, and see where it goes. It's been, when was the initial signal? I think the initial signal for this one would have been around July last year. Wide initial stop would have seen off that pullback, and then the wide trailing stop, which is generally below the 100-day moving average, has seen off all these pullbacks along the way. And this is the advantage of that wide trailing stop. Like, just how much is that? So there's a 21% pullback. So people often tell me, oh, look, I only want to risk 15% of my trailing stop. And that's all, well and good, but you're probably going to find it hard. And this has been a fairly smooth trend. This, as far as trends go, it doesn't get much cleaner than this. And even in this nice clean trend, you've had to sit through a 21% pullback. So if you're not prepared to give back 15% or more, you're going to struggle to stay on one of the cleanest trends which I've seen this year, let alone some of the other trends where stocks are coming back 30, 35%, and that's where those wider stops can really help stay in. So it's we may not like to have a wide stop because we feel safer with a tight stop, but the market really doesn't care what we feel best with. It's like, what's fit for purpose. And if you want to trade large trends that might go for 1 to 2 to 3 years, a 10 or a 15% trailing stop is not fit for purpose. It's fit for something else, but it's not fit for that particular job. So it's Catapult, lovely trend. I'm long, I'm staying long, and I'm using that wide stop for those reasons we just went through.
All right. GNP, buy the dip at 20 or 50 EMA is also the question based on these stocks. So,
nice trend here as well. Having this rebound off the averages. So look, when I see this, so there was potential for buy the dip as it came back to these moving averages. I'm looking at this rally through September into October. That was a strong rally, but then it came back just as fast as it went up. So that's probably, for me, it suggests that the stock's not ready to continue really moving higher at the moment. Maybe it needs more consolidation. And I wonder, and of course I don't know, but I wonder in this situation whether we could see another retest of the moving averages and some more sideways price action before then maybe getting going. So is this just part of a larger range which is in the process of forming? And of course, this is complete speculation. I don't know. I can't see into the future, but I've seen similar types of price action evolve this way in the past. And this is what you call a chart eye, where you see things and you can just do a mental overlay of what things could look like. Could look completely different. But for that reason, I probably wouldn't be in a hurry to buy this stock at the moment where it currently is, because I'm wondering, is it going to come back and retest these moving averages as part of a larger range? If I was in this one, I actually do think I am in this one. I lose track of some of the stocks. I mean, there's a few codes which are quite similar. But I do think I'm in this one. If I am in it, I'm happy to stay in it, and I'm happy to, because my wide trailing stop is wide enough to see off the potential of several more months of sideways price action. What my wide stop's probably back down here at a guess $2 or something if it's in fact in this stock. There's room for this to consolidate and chop around, but I probably wouldn't be rushing to add to a position at this point. I'd let this one develop and but continue holding in there with that wide stop.
All right. UNI.
Look, trends in place. I've got a bit of this one myself, and just because I'm in a stock doesn't mean it's a special situation, because it's like I'm just playing. I'm playing setups and I'm playing numbers. It's a numbers game. I just keep playing what I keep playing what I believe is a good process over and over again, and doesn't mean I get a good outcome, a profitable outcome every time I play. But if I keep playing a good process over time, the probability should work on my side. So I'm happy to hold this one. Whether it consolidates further or whether it's ready to get going, I don't know. My feel is with this one, I think there could be some more consolidation. But overall trend is still up. Is it a buy? Maybe. It does fit the criteria of pulling back to the moving averages. It's only just on it at the moment. If someone wanted to get into this one, I guess it takes a bit of a stop loss. I'd probably want to stop. I guess one way to play this would be just having a stop. You could try it with a 10% stop perhaps, or a little bit longer to get it below the 100-day moving average, 15% thereabouts. So for a buy the dip trade, there's possibility at current levels. Otherwise, see if it consolidates and then maybe buy breakout if that's what eventuates.
Okay. Actually, these were stocks from Talwyn, and she says, I've found it useful to keep ex-motion trader stocks with a nice long uptrend on a watch list, learn about the fundamentals, and when the trend changes, can consider buying it back in. So there you go. It sounds like a good thing to do. Let's have a look at GTG, please. GTG.
I'm sorry. I can't even say anything nice about this stock. It's just like, look at the moving averages, look where the price is. It's there's nothing I can really do with this one. Roger, as you know, I like to try and find a positive somewhere, but I don't want to encourage things which I just don't like either. So look, I just have to say this one's just a no.
Sorry there, Michael. I know you're an avid viewer of ours, but it's a no, absolutely no with that one.
And it doesn't mean that something can't happen. Like, look at this period back here in 24, where it was just going sideways, and then pop. It goes from 9 cents to 14 cents. So I'm not saying that that's not going to happen, but I just can't work on the basis of hoping that I'm going to get some and it's going to go pop. I'm going to quickly double my money. It could happen, but if I played that game over and over again, I'm pretty sure I'd do my capital and I'd be out of business. So anything can happen, but I don't think the odds are in its corner.
Yeah, of course. And I mean, obviously, if you're viewing this for the first time, look, please, if you've got a reason to buy this, go ahead. We are just saying no. This is all general advice as usual. Please do your own research and make your own decisions, right? So, all right, Vulcan. Let's get on to Vulcan.
It's still uptrend, doing all the right things. It's a bit stretched above the averages. Don't be surprised if it does have some sort of a pullback and does some consolidation for maybe several weeks, but the underlying trend remains in place. I still think this is, if I had this, I'm happy holding it. I'm happy to give it plenty of room to move and see where it goes. Some of these stocks can go hundreds of %. Others look promising and then find their way back down, and you're out at small profit or break even or a small loss. But it's got the building blocks for something good to happen. So let's see whether it keeps building.
All right, fantastic. And final one, KAU, please.
And just seeing our history on it. It's a bit messy. I don't like when they run quickly and strongly, and then they come all the way back. It's like, well, share price ran, and then there was hit some good distributions. There was someone was ready to start unloading into the rally, and they've unloaded all the way back down to where it came from. So I'd be inclined to, look, I would leave this one alone, even though it's got rising moving averages. It's kind of around slightly above the 100-day moving average. I'd really need, would have been better had it just like held onto the gains, a bit like what I was talking about the S&P 500. Is it froth and hype or the real thing? If it's a real thing, it should hold on to the gains, a large portion of the gains, and consolidate. The moving averages catch up and holds on to the gains because there's buyers underneath who are trying to buy the pullback. That wasn't the case here. They weren't trying to buy the pullback. They kept trying to sell into what was left of the rally. So it's not the right type of setup. It's not to say it can't stabilize and then start to turn higher again, but I don't think the wind's at our back with this one just at this point in time.
Okay. All right. I think we are done for today, which is probably about 10 to 15 minutes earlier than what we would normally go for. So we get to give that time back to our viewers and to us, obviously, it's great. It's been a good. Oh, sorry, we've just come in with one more. Let's just get onto it. CQR. If I should sell at BE with break even with dividends, I'm assuming BEs. We don't know what your break even point is, obviously, Terry, but. Yeah, CQR. Let's have a quick look at that one. But this will be the final one because we'll kind of...
where's that trading? Yeah. Well, look, it's this is a range, and you can draw our levels in on this. It's it's your classic contracting range. Is it also like acting as a base from higher levels? I'd be look. I don't think we've got the trend in place at the moment with this because I think it's oscillating either side of the averages. I'd have a slightly bullish tilt to my look on this because I'm wondering, is this a basing phase? Just property in some of those property trusts in general, can they base and then break higher? But look, we don't have a breakout at this point. I wouldn't have this in my portfolio at the moment. Oh, look, could we have called that a breakout? Look, possibly we could have said, look, price has gone from below the averages to above. There could have been an entry. I'd probably say, look, the exit point would be maybe like if you want to use a price exit, I'd probably just use the recent low. If you can, like, it's a nice rally off that low. If it can hold that recent low, maybe it can consolidate and then start to break higher. If it takes out that low, well, then it's like, well, maybe I'll just move on to other things. Or if I bought it in September as prices were breaking out, maybe I'd also be thinking about a time exit. Well, that's what I'd be doing because I use time exits. Not everyone uses them though. But then, that's another possibility. Saying, look, I've been in this for a couple of months, 2-3 months. It's not really doing much. I've got a couple of other ideas I like. I'll close this one out and I'll jump into something else. That's a reasonable thing to do as well. But if you don't need the capital and it's holding above a certain point, you're getting a good dividend from it. Again, there's nothing wrong with holding a stock like this because it hasn't broken down. It's just going sideways within a range. So there are several options with this one. We'll know the best one in hindsight. And but for now, we've got a stock which is trading sideways, not doing anything too exciting.
Yeah. Charter Hall is beautiful buildings they have. I know we're in one in Melbourne. They're not letting us go, Jay. Sorry. So there's just one more there, which is good. Obviously, EZZ. Let's just have a quick look.
Okay, back again.
Yeah, back again.
Okay, let me guess. Here we go. EZZ. Yeah. This is like when a stock goes vertical. This is always the risk that it comes back hard as well. And this had gone, like it had it's done this before. It went vertical back in July and then had that big pullback to the averages, and then it's done it again. Now it's come back to these averages. I think the best you can do in these situations is wide trailing stop and see what happens. I probably wouldn't be inclined to buy the dip on it. It's a stock which probably doesn't have revenue. It's probably a stock which isn't profitable. I don't know whether I don't know, but I'm not sure. I've got a feeling I've looked at some aspects of this in the past. I'm not sure the background of it, but it's not a stock which is like paying a 5% dividend and got increasing revenues and so on. It's based on, I think, good things needing to happen to justify where it goes. Of course, got to go check all that out yourself because I'm just going off some vague memory. So it's it's not a dip I'd want to buy. But if I got in on early on in the piece, and it's probably just above a wide ATR based trailing stop, I could keep holding it. But if it hit my stop, I'd be exiting. It still could stabilise here as it did back in July. But then, we also know how like a stock like Drone Shield played out, where it gets these big gains. And remember, this has gone from 50 cents to $5. It's a tenfold increase. Probably don't look at too many stocks that go tenfold and then go, double, treble the next year as well. It can happen, but the run could also be at an end. So I just want to know where my exit point is and be happy to rule off and hopefully make a good profit at the wide trailing stop should it keep coming back.
All right, thank you very much for that. There is a question there which we will look at after we finish this show, Talwyn, around possible ETF trading strategy. Be possible. I think a lot of the information we're going to give is very similar to what we do with individual stocks. But let us discuss this offline, obviously, with Jace. There was another question a few weeks ago around having some sort of playlist around our original training series. Like I've got a list of those now. So if you do want that, if anyone wants that, I know it's easy to find on YouTube if you want to trawl through it. But if you do want the list easily accessible, then send me an email to support@selfwealth.com.au and I will shoot you that list. So it makes it easier for you. Just attention it to Roger and it'll arrive to me. All right. And if you have any other questions around the platform itself, Selfwealth, then obviously you can just direct them to me as well if you'd like. If you have questions around Jason's service, obviously he's over at Motion Trader, motiontrader.com.au. You can certainly sign up over for him. All the links are below, on this video as well. So feel free to try things out. Otherwise, Jace, thanks again for a great session today. We'll be back next week, obviously. Yep.
Yeah, that was all good. Thanks, Rog. Thanks for hosting, viewers. Thanks for coming along. Some great questions, some interesting stocks. It's look forward to it next week.
Thanks, mate. I almost called you Roger there, but that's okay. I confused myself with your name underneath me. So on that note, we'll leave it for a great show that it was today, and we will see everyone next week. Thanks everyone for coming. Don't forget to like, subscribe, and comment as you normally would. And that's been great. Thanks, guys. Have a good one. Take care. Bye bye.